Hello, everybody. Welcome to episode 2 of the weekly wrap. I'm coming at you on Saturday, July 16th. That's when we are recording 2022. And I'm really excited about this episode. There's a lot happening in markets and the economy right now. So let's just get into it. So I wanted to open up with this article from the Wall Street Journal. I'm not going to go through the whole thing, but there are some things in here that I want to touch on that are relevant to what I think investors should and shouldn't be doing right now, and also just kind of my outlook on the markets right now. So this article from the Wall Street Journal is titled, "Stock Investors, After a Brutal Stretch, Have Rarely Been This Pessimistic." Traders are betting on bigger losses for equities as the S&P 500 heads toward its worst start to a year in 2 decades. So mainly this is just kind of talking about like how bad the sentiment is right now in the market, and that people are getting fearful and they're fearing that the markets are going to go down even lower, and that a lot of the outside variables that have been affecting the markets are not going to get any better. So I just want to talk about it a little bit. Asset managers and hedge funds recently stepped up bearish bets against U.S. stocks. So if we take a look at this chart, it's the positions in U.S. equity futures by asset managers and leverage funds such as hedge funds as a percentage of open interest. And that is a mouthful. But basically what it means is when this chart is higher, it means that hedge fund managers and institutional investors are betting that stocks are going to go up in the future, basically is all it means. It's basically kind of, you can use this chart as like a forecast of what institutional investors are betting on. So as you can see, it's spiking to the downside. I mean, it's matching its low from February 16th, 2016. As you can see, a lot of institutional investors are expecting the climate in the economy to get worse, and they're expecting equities to suffer as a result of that. So that would go along with the sentiment of individual investors or retail investors like you and me and anyone who just takes part in the markets that's not an institution. This says that U.S. consumers expect stock prices to stay flat or tumble. So that basically means that they're not expecting it to go up, and they say that this is the highest proportion that they've had since this survey began in 2013. So we're seeing record bearish sentiment right now. And before I get into what all that means, I'm gonna keep going through this a little bit. So this chart is net bullish options volume. So basically what that means is when this chart is higher, there's more bullish options being placed in the market, and when it's falling, there's less bullish options, and there's more bearish options like puts or people shorting the market. And so as you can see, this is at a low right now. We're at a low. This chart only covers the last 3 years, but as you can see, just any sort of consistent bullish sentiment or outlook on the market has been completely wiped out since the start of 2022. And additionally, the bond market has been flashing recession indicators. We see the inverted yield curve, which recently reached its widest level in 2 decades, and that's kind of like a canary in the coal mine signal, screaming that we're going to face a recession. But this is really the biggest thing that I want to focus on, and that's that the Federal Reserve is indicated that they might raise interest rates by a full percentage point at the next meeting. So really, what does that mean? And to me, it's telling me that over this new period of quantitative tightening that the Fed has instituted, we've seen a consistent pattern of them raising the amount that they raise the interest in. So initially they were raising it by 25 basis points, and then we saw a 50 basis point rate hike, and most recently we saw a 75 basis point rate hike, and now they're talking about a 100 basis point rate hike. So a full percentage point higher in the interest rate. And we haven't seen that in about 30 years. So to me, we're still in the midst of the Fed really tightening the economy. And if you're someone who likes to use indicators on whether stocks are going to go up or stocks are going to go down, I mean, really, the best indicator you can use, and it trumps every other indicator over time, is QE and QT. Is the Fed easing the economy? Do we see an easy money policy? Are rates falling? And in those time periods, you see stocks go up and prices go up because equities are just so manipulated by what the Fed does at this point in time. And when you see quantitative tightening, which is what we're in right now, you see asset prices fall regardless of what else is happening in the world and in the economy. And right now, frankly, we're seeing a lot of outside factors compiling on top of the Fed tightening the economy that are really putting a lot of pressure on equities and the economy as a whole. So it's a hard time to be bullish, but I say all this to say that doesn't last forever. Eventually, the Fed will go back to a QE policy, whether that's in a week, whether that's in a month, whether that's in a year, it doesn't matter. It's going to happen again, and stocks will go up again. So all this to say that, look at this. So look at this chart. Cash allocations among individual investors, and you can see since about August of 2021 and all through this year, it's spiking. So what's that say? It says that the average institutional investor, according to this article, is holding 21.2% cash right now. And that can be a dangerous game to play. If you're a long-term investor, if you have a long time horizon, the data says that it's not good to try and time the market and sell out and buy back. The data shows that if you buy and hold for long periods of time, you're going to become wealthy. So what am I trying to get at here? What I'm trying to get at is that the Wall Street Journal, other financial outlets, they're run by these massive entities. And yes, there's bearish sentiment. There are plenty of reasons to be bearish. If you're a trader, that might be a good opportunity for you to go to the bearish side. Yes, I'm not denying that at all. But for someone like me who has a 30+ year time horizon to invest, and for I'm sure a lot of the people that watch this video or listen to the podcast, you have a long time horizon. You're a long-term investor. You can't let yourself get caught up in this type of sentiment and fear and let yourself sell out of assets, because what you're going to do is you're going to miss the best prices to buy in. Warren Buffett, he has a great quote, and I don't know the exact quote, but he says something along the lines of, you go to the grocery store, and if you saw that all the prices were 50% off, what would you do? You'd start buying up all of these groceries in the grocery market because the prices are falling, and these are things that you need that to enrich your life with any store. Really, it could be applied to. And he goes on to say that the stock market is the only place that investors sell, where people sell when they see assets that they want to own, the prices falling. So I say that to say, look at it this way. So let's say I own Apple stock, and I owned Apple stock for a long time. It was up in, I believe it was in like the 180s at one point. And now it's falling. And let's say it falls even farther. Let's say Apple stock goes to $90 and it's cut by 50%. Should I sell Apple stock? Has my thesis on Apple changed at all? No, it hasn't. I think Apple is a great business. I don't think the stock price has anything to do with the quality of the business. I think they're going to continue to make money. I think they're going to continue to separate themselves from the competition. And I think that they're going to continue to be a fantastic business for a long time period. So what should I do? I should keep buying at the lower price because I'm getting a better price for the same asset, or maybe a better asset. So I think it's important not to get scared out of your investments, especially in a time like we're seeing now. It can be really scary, especially with all the things happening throughout the world that are affecting the economy. But the biggest indicator with the stock market is basically what the Fed does, at least in the United States, whether they're easing the economy and tightening the economy. And right now we're in the thick of them tightening the economy. So we're going to see the worst of it, and that's not a time to sell. That's a time to buy, because that's where you're going to see the best returns, is buying at the lowest prices. So I just wanted to say that because I know a lot of people are feeling really scared. There haven't really been a lot of places to hide in the markets. Gold and Bitcoin and some of the other things that are seen as inflation hedges haven't really been hedging inflation that well. And really, unless you're in energy, oil stocks, stuff like that, that's the only thing that's relatively held up. And that's not something that can be sustained. So I just wanted to say that. But I have a couple charts. We're going to do some technical analysis on a couple charts now. And I want to start with the S&P 500. I'm looking at the Vanguard 500 index fund. And last week we talked about how we might see some rallying continued into this moving average right here, or into this zone if the market does go bullish for some reason. And a reason why I could see the market going bullish or starting to buy stocks is if they see inflation start to get under control. So what do I mean by that? I mean, if they see, sometimes you get this kind of reverse psychology type of thing in the markets, at least for a little bit in the short term. And that is, the Fed will come out and say they're going to be hawkish on the economy. And I just said that that's a bearish signal, and it is. But sometimes the market might read that as a good sign that the Fed is going to attack inflation, and that they're going to tighten the economy, and that in the long run, because the stock market is a long-term vehicle, the stock market looks ahead when it's pricing assets, that they might say, okay, so the Fed is trying to better the economy, so this is good for stocks in the long term. And yeah, so you might see a little surge, and that could be a little bit of a trap by Wall Street, because we're still in the midst of this quantitative tightening, and there hasn't been any indication of the Fed easing. So yeah, we might see a 100 basis or 75 basis point hike, and that could push the market temporarily higher into this moving average or this zone, or even this zone, but we'll have to see. We're not going to get ahead of ourselves. It could temporarily surge the market, but the actual consequences of them tightening the economy, in my opinion, should bring the market lower. I think that stocks are still historically overvalued, and if they're going to continue to be this tight with the economy, then it should, long term, if they stay that way, push stocks lower. Now, that can change if they go back to a QE policy, but I'll be the first one to get on here and tell you that that's happening, and it's not happening yet. So that's what I expect. We did see stocks fall for the first 4 days of the past week, and then on Friday we saw a really big rebound day, and stocks bought up at the end of the day too. So we'll just have to see. Right now we've got some chop in the market, and usually when you see coiling like this or chop, you can go back. Let's look at it. So there was some chop up here, and then when it broke to the downside, and it was a heavy move. Chop right here, heavy. Chop right here, heavy. Chop right here, broke to the upside, heavy move. So I am expecting a big move here from the market at some point as it's still coiling. And whether that's over this moving average, or maybe it comes into the moving average and drops below, we don't know yet. So that's what we're looking at right now on the main S&P 500. And as you can see, I kept this moving average on the chart because it just respected it so beautifully all the way up. And then now we're below, so I'm going to respect that trend, and I have it on the chart. But again, we looked at Apple last week. I want to look at Apple again because it's kind of going along with what I've been saying. We expected when Apple broke through this little short-term trend line that it would move to the bullish side, and that's what it's done. It's just been surging to the upside so far. And, we expect a little bit of pressure at this level from 152 to 157. We expect selling pressure in Apple, especially in this economy right now. Raising rates are not good for tech stocks, and Apple is the biggest of them all. So, we could see some continual buying into this zone, and then that would also correlate with the S&P 500 going up. because Apple is the biggest company in the S&P 500. It has the biggest weighting. So we could see a little bit of correlation there with that, and then some selling. So if you tuned in last week, everything's been going exactly how we said it probably would, and we're still in that trend right now. We haven't hit this resistance yet, and that's something that could happen soon. But there have been some places in the market that have opened some opportunity, and I want to take a look at that right now. And the index that I'm going to be looking at is ARK Invest. This is Cathie Woods' fund. This is a fund with a lot of, I guess, controversial stocks that have just been in the news a lot because of the nature of Cathie Woods and her funds. So I just want to take a look at this because these stocks really reflect the QE/QT dilemma, and that is when interest rates were falling, money was flowing into assets, and we all thought we were going to be locked in our homes forever. These stocks just skyrocketed during the COVID quantitative easing, and they got all the way up to about 160. This index did, and then they fell when the Fed reversed its plan and went to quantitative tightening, and they've sold all the way off, and they sold off almost to the bottom of the COVID crash. And if you go, and we won't do this, maybe we'll do this in a separate video, but if you look at the companies inside of this index, they've actually been growing revenues, growing profits. They've been growing, and yet they're trading at the same levels that they were during the beginning of the COVID crisis before the Fed started pumping all this money into the economy. So I'm not saying go out and buy ARK Invest, but I am saying there is opportunity in the market if you know where to look. And this is something that is cheap right now. Now, is this the bottom? I don't know if this is the bottom. It could definitely go lower, especially if we continue to see the Fed tightening continually. So I'm not saying that this is going to skyrocket from here. I'm not saying that this is the bottom, but I am saying that there's opportunity in the market. And the top two holdings in this fund are Tesla and Roku, and those are two great companies, Tesla especially, and they're on huge discounts. So you kind of diversify yourself within this like field of investments by buying this fund of just hyper growth stocks. She calls it the innovation fund because these are companies that ARK Invest believes that are going to disrupt our current technology industries and just our current industries and change the way we live our lives. They argue that the world is going to change faster than we think it's going to. If you look back just to 1990 to today, or 2000 to today, or even 2007 when the iPhone came out to today, we've experienced the biggest technological advancement in the shortest period of time ever in the history of our planet, ever. Doesn't matter what species has been here ever. This is the biggest technological advancement. And she says that rate of advancement is going to continue to grow. So we're going to continue to see technological advancements at a faster and faster rate as we continue to get better and as these companies continue to grow. So that's her thesis, and her stocks are at a huge discount right now. So there is opportunity in this market. It's not all, we still have so much room to fall. Obviously, I'm not saying that this index fund is at the bottom, but it would take a lot for this fund to go below its low from COVID. That's all I'm going to say. So we could see this fund still has, 10-20% down to the bottom of COVID to get back there because it's kind of rallied since it hit this zone. But, that's a heavy support there, and it's something that I've been looking at. So I do want to hop into Bitcoin again. I know we cover this in the daily dose often, but the crypto markets have been under a lot of scrutiny. We saw Celsius declare bankruptcy. And I want to say, because, I'm a new investor. I'm not a new investor, but I'm a newer investor. I'm still learning. And one thing I've learned about the crypto space that's really important is self-custody. So we saw Celsius go bankrupt. We saw another one go bankrupt. It's slipping my mind, but it kind of reminds you of 2008 when we saw some of the banks start to go under, and then the Fed realized, hey, we can't let all these banks go under because then our whole system collapses. And so they bailed out the banks. If something similar happens in the crypto space, and yeah, it's kind of starting to seem like something like that is happening now with these exchanges going under. The Fed has absolutely no incentive to bail them out. Absolutely no incentive. And if anything, they have the incentive to let them fail, because some of these cryptos are just direct competition to what the Fed does. And why would they ever bail something like that out? It just doesn't make sense. Now, I'm not saying the Fed wants Bitcoin to go to zero, but some of these other cryptos, it's competition. And the Fed's going to win that competition because they have all the power. So what happens when these crypto exchanges go bankrupt for most of them is, to cover the bankruptcy, they sell the assets on the exchanges. So what does that mean? It means they're selling the crypto that you own and then paying off their debts with it. So basically, it's not your keys, not your coins is the term, and I can't really think of a better term, but that's really scary to think about, because basically what you're doing when you're buying coins on these exchanges is you're lending them to the exchange with good faith that when you want to sell, that you're going to be able to get your money out. And for a lot of these investors, they're learning that that's not really the case. So one thing that I'm doing is I'm in the process of ordering a hardware wallet. I'm going to be transferring. Personally, I only own Bitcoin and Ethereum. As you can kind of see on the side, I realized my portfolio was kind of showing, so I got rid of that. But Bitcoin and Ethereum, I'm going to be transferring all that off of the exchange that I hold it on, and I'm going to be transferring on the hardware wallet, and I'm going to put it in a safe. And I'm going to memorize my seed phrases, and then no one will be able to take that from me. Nobody. It doesn't matter if the aliens come and they overthrow all the governments, they won't be able to steal my money from me unless they just torture the phrase out of me. But that's the only way. So I'm going to be doing that, because if we do see this continuation of a trend of exchanges going under, the Fed has absolutely no incentive to bail them out. They're not going to bail them out. And more than likely, if you own your coins on an exchange and it goes under, there's a good chance you're not getting your money back, or you're not getting all your money back, and then it's going to take a long time. So even if you do. So let's take a look at just like the fundamentals on Bitcoin here. I got the weekly chart up. This is the trend line that we've kind of drew. Bitcoin's rallying today. So Bitcoin right now, it's at 21,284. We said that it could rally into this zone. If it gets past 22.5, we said maybe it'll get to 27-ish thousand, but then it's going to hit this trend line. So we could see some more consolidation. We could see it break out and hit this trend line. Right now, we have no confirmation of it moving one way or the other, but it is rallying to the top of this zone right now. So that'll be something to keep your eye on. But I'm going to wrap it right there. I kind of dumped a lot of information in this episode, so be sure to take another listen back through. If you're watching on YouTube, make sure to support us in the podcast. There's a link on the YouTube page to do that, to follow on Spotify, Apple Music, Amazon Music. There's a link there as well to support. If you want to donate to the podcast, that'd be greatly appreciated. If you want to donate to the channel, it's that same link. You can just follow it to the podcast, and there's a support button there that you can make monthly contributions. If you're listening, make sure to subscribe to us on YouTube. We come out with an episode of the Daily Dose every business day. Just quick little video recapping what happened during the day. Every weekend we come out with one of these episodes. This is the second weekly wrap, and I'm working on some special series too that I'm really excited about. So needless to say, thank you for joining us on the second episode of the weekly wrap. Make sure to join us this week during our Daily Dose, and I'll see you guys all next week. Thank you for joining me.